Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Sounds good.
Right now, there is basically $21 trillion just sloshing around the global exchange-traded fund market. I mean, it is absolutely raining money out there.
Oh, completely pouring.
Yeah. But if you look closely, like right under the surface of this historic boom, Wall Street is quietly shutting down hundreds of actively bleeding, totally scarved funds. And these are known in the industry as zombies.
Yeah, the zombie ETFs.
Right. So today, for this deep dive, our mission is to figure out why a market that is literally richer than it has ever been is leaving so many of these investments to just die. And more importantly, how you might actually be holding one right now without even knowing it.
The contrast between the headline numbers you see on the news and the actual underlying plumbing of the market right now is just stark.
Oh, for sure.
Based on recent analysis, as of April 2026, global ETF assets hit a record high of $21.91 trillion.
Yeah, that's trillion with a T.
Trillion, exactly. And the U.S. market alone accounts for 14.8 trillion of that. I mean, we saw a massive $856.38 billion in new inflows just in the first 4 months of the year.
That's almost $1 trillion of new money just boom right into the market in 4 months.
Right. Investors are pouring cash in at just completely unprecedented rates.
Okay, let's unpack this because it creates a really fascinating paradox.
Yeah.
I was trying to visualize the current state of things for you guys listening, and the closest comparison I could come up with is like a booming, newly built American mega mall.
Okay, I like that.
Right. So you walk through the main entrance of this mall, and there are 3 giant multi-level flagship anchor stores. And they are packed shoulder to shoulder. The cash registers are ringing nonstop. Everyone's buying.
The heavy hitters.
Exactly. But then you look down the long, sprawling hallways of the rest of the mall, and they are littered with hundreds of tiny abandoned kiosks.
Just ghost towns.
Right. No customers, no sales, just gathering dust while millions of dollars flow into those big anchors at the front.
What's fascinating here is that the mall management is essentially letting the big anchors dictate the entire ecosystem. Because to understand why those smaller kiosks are abandoned, we really have to look at the gravitational pull of those flagship stores.
The ones sucking all the oxygen out of the room.
Precisely. Based on data from June 3, 2026, we actually saw a massive historical milestone. Vanguard's S&P 500 ETF, the ticker symbol is VOO, became the first ETF ever to cross $1 trillion in assets under management, or AUM.
$1 trillion in a single fund.
A single fund. It beat out its closest competitors, which are State Street's SPY, that one sits around $785 billion, and BlackRock's IVV at $860 billion.
I mean, $1 trillion is a number so huge it almost loses meaning. That's more than the GDP of a lot of actual countries.
Oh, absolutely.
And from what I understand, Vanguard won that race to $1 trillion for a very mechanical, almost boring reason, right? Their fees.
Yeah, they basically drove the cost of investing down to the absolute floor. VOO charges an expense ratio of 0.03%.
Wait, to 0.03%.
Right. So if you invest $10,000, they are charging you like $3 a year to manage it. And for that $3, they give you broad exposure to the 500 largest companies in America.
Wow, $3.
Yeah. So when the cost of participation is practically invisible like that, institutional wealth and everyday retirement money naturally flood into that specific fund. It creates this extreme winner-takes-all environment.
So the flagship stores are doing just fine. But let's talk about those abandoned kiosks down the hall, the zombie ETFs. What actually makes an ETF a zombie? Like, officially.
The industry generally defines a zombie ETF as a fund that has been trading for at least 3 years, but has failed to gather $50 million in total assets.
Wait, I have to stop you there. This is where the math feels totally disconnected from reality for me.
How so?
If there is almost $15 trillion circulating in the U.S. market alone, and we are seeing record-breaking inflows every single month, how on earth are hundreds of funds failing to scrape together just $50 million bucks? Are these asset managers just launching terrible, useless products?
Well, it really comes down to a fundamental misunderstanding of market averages versus the median reality. If you look at high-level data, the average ETF size has jumped from $1 billion 10 years ago to $3 billion today.
Okay, but that average has got to be distorted by the trillion-dollar giants, right?
Sure.
It's like saying if you and Jeff Bezos are in an elevator together, the average net worth in that elevator is over $100 billion.
Exactly.
That doesn't mean your personal bank account looks any better.
That is the exact mathematical trap right there. The
Mhm.
top 1% of funds are holding the vast, vast majority of the capital. The median fund, like the actual experience of a typical ETF right in the middle of the pack is just fighting for scraps in an incredibly crowded hallway.
But if these funds are starving, and everyone on Wall Street can clearly see that the top three players are eating all the food, who is paying to keep the kitchen open? Why do asset managers keep launching new funds if the odds of survival are so historically low?
Because the barrier to entry to launch a financial product has just completely collapsed. I mean, 10 or 15 years ago, launching an ETF required massive internal infrastructure.
Lots of overhead.
Tons of it. But today, there are white label services. An asset manager can essentially just rent the legal framework, the compliance team, and all the trading infrastructure.
Oh, like a turnkey solution.
Exactly. They just slap their specific strategy and their branding on top. So the launch speed we are seeing as a result is completely unprecedented. The research shows there were 93 new ETFs launched in February 2026 alone.
93 in 1 month.
Yeah. And by May, active ETFs pulled in a record $70 billion.
I actually saw a statistic regarding this launch speed that seems almost like a typo when I was looking at the data.
The Corgi numbers.
Yes. In early June 2026, a firm called Corgi launched 35 ETFs on the Cboe BZX exchange in a single day.
Yep.
And they didn't even stop there. They rolled out 50 new ETFs within a single week.
And here's the kicker. 34 of those 50 were 2x daily leveraged ETFs. They're just flooding the market with these highly aggressive, highly specific, risky products.
It honestly reminds me of a desperate content creator on YouTube. Instead of taking the time to make one really high-quality video, they launch 50 different channels about 50 completely random topics.
Right. Hoping for a hit.
Exactly. Like one channel is about unboxing blenders, another is reviewing shoelaces. They know 49 of those channels will get 0 views, but they're just praying the YouTube algorithm randomly picks up one of them, makes it go viral, and the ad revenue from that single hit pays for the whole operation.
That is a perfect analogy. That venture capital mindset has completely taken over the public markets. Asset managers are just throwing spaghetti at the wall to see what sticks. And the mechanics of fund operation explain why they are so willing to take that risk.
Let's get into the plumbing then. What does it actually cost them?
Keeping an ETF alive costs roughly $250,000 to $300,000 a year in fixed costs.
Wait, what are they actually paying for? The stock market is completely digital now.
Well, you have to pay licensing fees to whoever created the index you are tracking. You have heavy legal and audit fees. And crucially, you have to pay for market making support.
What's a market maker, for those who might be new to this?
A market maker is a financial institution that stands ready to buy or sell shares of your ETF at any given moment. They ensure trading flows smoothly and prices stay stable, and they charge a hefty fee for providing that safety net.
Okay, got it. So keeping the lights on at the little kiosk costs about 250 grand a year.
Right. Now apply that to the zombie threshold we talked about earlier. Let's say an ETF has managed to gather exactly $50 million in AUM, and they charge a management fee of 0.50%.
Okay.
If you do the math, 0.50% of 50 million is exactly $250,000.
Wow. So at $50 million, they are literally just scraping by, breaking even, meaning anything below that, the asset manager is paying out of their own pocket to keep the fund open.
Exactly. They are actively bleeding cash. But they tolerate the bleed because of pure FOMO, the fear of missing out on the next mega hit.
They want that viral YouTube channel.
Yes, because if just one of those 50 random funds catches a cultural or economic wave and hits, say, $2 billion in AUM, the management fees from that single jackpot will cover the losses of the 49 failures 10 times over.
And we actually have a textbook example of that jackpot happening recently, don't we?
Oh,
This is the viral hit that basically triggered the current gold rush of all these copycats.
Oh, yeah.
Let's talk about the DRAM miracle.
The Round Hill Memory ETF, trading under the ticker symbol DRAM, it launched on April 2, 2026, and its trajectory completely scrambled the brains of every small asset manager on Wall Street.
The numbers are insane. It raised over $6 billion in just 5 weeks. By mid-May, it was nearing $10 billion in assets, and its share price had shot up over 98%. It became the fastest-growing ETF in financial history.
Yep.
But why? Like, it couldn't just be a trendy tech name, right?
Yeah.
People aren't that gullible.
No, it wasn't just a gimmick. DRAM exploded because it solved a very real mechanical bottleneck for investors. Everyone knew artificial intelligence was driving the market, but the actual choke point for AI development wasn't just the processors.
Right.
It was the memory chips required to feed data into those processors.
Sad.
The problem for the everyday investor was that standard U.S. semiconductor ETFs didn't provide heavy exposure to the foreign companies that actually dominate that high bandwidth memory space.
We're talking about companies like SK Hynix in South Korea, or Samsung, or Micron.
Precisely. Before DRAM, it was really complicated for an average mom-and-pop retail investor to get concentrated exposure to SK Hynix. DRAM built a direct bridge to that specific overseas bottleneck. It offered genuine utility that the market was starved for.
Okay, so it wasn't a gimmick. It was a required tool. But I imagine the rest of Wall Street didn't learn the lesson of, build a unique, useful tool. They probably just learned, put a tech word in the title and get rich.
If we connect this to the bigger picture, the success of DRAM unleashed an absolute tidal wave of lazy copycats. Asset managers saw that $10 billion influx and immediately started rushing out next-gen AI funds, space exploration funds, advanced robotics funds, basically anything with a futuristic wrapper.
Which brings up a really dangerous illusion for the everyday beginner investor. Let's say I'm trying to be responsible, right?
Okay.
I know I shouldn't put all my money into one stock. So I buy an AI ETF, a space ETF, and a cybersecurity ETF.
Yeah.
In my mind, I have diversified my portfolio across 3 entirely different sectors of the future economy. I am protected.
Yeah. You are experiencing fake diversification.
Ouch.
Based on recent analysis of these newly launched thematic ETFs, if you open the hood and look at the actual engine, they are almost identical. You buy the space fund, the robotics fund, and the AI fund, and you look at their top 10 stock holdings. What is actually inside all 3? NVIDIA, Microsoft, TSMC, Palantir.
Wait, seriously. So regardless of what the cool futuristic label on the box says, I am literally just buying the exact same 5 tech giants over and over again.
You are making a massive concentrated bet on the same handful of mega cap tech stocks, but you are paying 3 different, highly elevated management fees for the privilege.
That is brutal.
You aren't diversifying risk at all. You are just duplicating it under different marketing banners.
Man. And earlier we mentioned Corgi launching 34 different 2x daily leveraged ETFs in a single week. I feel like we really need to address the mechanics of those because a beginner investor might see a 2x AI fund and think, great, if the tech market goes up 10% this year, I make 20%. That sounds like a really smart long-term hold.
That assumption destroys portfolios.
Really?
Yes. A 2x leveraged ETF is not designed for long-term investing. It is a tactical, short-term trading tool, usually meant to be held for a single day. We have to look at the math of how they work, specifically something called volatility drag.
Okay, walk you through the math. Let's say I put $100 into a normal index and $100 into a 2x leveraged ETF.
Let's say the market is a bit choppy. On Monday, the normal index drops 10%. Your $100 is now $90.
Right.
The 2x leverage ETF drops 20% because it's double, so your $100 becomes $80.
Right. Painful, but I expect double the pain on a down day if I'm taking double the risk.
Here is where the daily reset breaks you.
Okay.
On Tuesday, the normal index rallies and goes up 11.1%. That brings your normal index back to exactly $100.
So I'm flat for the week. Not
Right. Now, the 2x ETF goes up double that, which is 22.2%. However, it is calculating that 22.2% gain on Monday's closing price, which was $80.
Oh no. A 22.2% gain on $80 is only, what, about $17.76?
Exactly, meaning your 2x leverage account is now sitting at $97.76. The normal market recovered completely to zero, but your leverage fund is down over 2%.
Just from the math resetting.
Yes, multiply that math over a full year of choppy, volatile trading, and the leveraged fund will mathematically decay and bleed out your capital, even if the underlying stocks eventually go up.
That is a terrifying mechanic if you don't actually read the fine print. And I guess it leads us to the broader risk hanging over this entire $21 trillion market.
Macro picture.
Right. Fake diversification, bleeding zombie ETFs, these leveraged math traps. It all seems totally manageable when the market is setting record highs every week. But what happens when the weather changes?
Industry analysts are currently warning about the potential for a hard rain. Right now, the broad market is being heavily buoyed by this massive artificial intelligence tech rally. But underneath that, the macroeconomic foundation is incredibly complex and fragile.
Especially right now. I mean, we are looking at The fluctuating interest rates, super volatile oil markets. And, under the current Trump administration, there are always ongoing trade renegotiations, tariff discussions, and geopolitical tensions that can pivot market sentiment literally overnight.
Exactly. The policy environment is very dynamic. If a sudden shift in trade policy shocks the tech sector, or if the AI rally simply runs out of steam and investor money pulls back, the asset managers running these zombie ETFs are going to face a brutal reality.
They'll lose that lifeline.
Yep. A fund hovering at 50 million suddenly shrinks to 30 million. The management fees dry up completely. The asset manager is now losing hundreds of thousands of dollars just to keep the lights on.
And they're not going to just sit there and take the hit.
No, they won't wait around for a recovery. They will pull the plug.
And we are already seeing the early stages of this consolidation in the data, right?
Absolutely. Even in a booming market, ETF closures are a weekly reality right now. For example, on June 3rd, 2026, Goldman Sachs slated several of their corporate bond ETFs for closure.
Wow. Even the big guys are getting the fat.
Yeah. We're also seeing massive industry consolidation where the big players just swallow the infrastructure of the smaller ones. Goldman recently acquired Innovator Capital Management. And in a highly publicized move, Truth Social Funds is actually attempting to acquire the God Bless America ETF.
Interesting.
The big fish are eating the little fish, and the funds that don't get eaten are just being shut down.
So what does this all mean for the individual listener? Say I own one of these small niche ETFs. It has like $20 million in assets. The danger isn't just that the stocks inside it might perform poorly, right? There are actual structural dangers to owning a zombie.
The first structural danger is liquidity, specifically what's called the bid-ask spread. When a fund is small, there is very low daily trading volume. There just aren't many buyers and sellers actively interacting with it on the exchange.
It's kind of like trying to sell a highly customized, extremely weird used car.
Yeah, perfect example.
Because there isn't a long line of buyers waiting for it, the dealership knows they have all the leverage, so they offer you a terrible price for your trade-in.
The market makers act exactly like that dealership. Because they are taking on more risk to hold a low-volume ETF, the gap between the price you want to sell at and the price they are willing to buy at gets incredibly wide.
So if I panic and try to sell,
If the market takes a dive and you panic and hit the sell button on a zombie ETF, you are going to take a significant haircut on the price just to find a buyer. It acts as a hidden penalty tax on your investment.
man. Okay, but what if I don't sell? What if I just hold on, but the asset manager decides to close the fund entirely and delist it? Do my shares just vanish into thin air?
No, the underlying stocks still exist, so the actual value doesn't vanish, but the fund undergoes what's called a forced liquidation. The manager sells all the assets and converts them to cash, which they eventually distribute back to you.
Which, I mean, that sounds fine on the surface. I get my money back.
But you are getting it back on their schedule, not yours, which completely disrupts your financial planning. Think of it like putting a large cash down payment on a house in a brand new, unproven subdivision. Halfway through construction, the builder realizes they aren't selling enough units to make the neighborhood profitable.
They don't just leave me with half a house and empty field.
Right. They cancel the entire project, bulldoze the framing, hand you your cash back, and force you to go find a new house in a totally different, probably way more expensive real estate market.
And here's the absolute worst part of that scenario for investors.
The taxes.
Oh, yes, the taxes. If you are holding that ETF in a standard taxable brokerage account, so not a protected IRA or a 401k,
Yeah.
that forced liquidation is legally treated as a sale.
Oh, no.
It generates an immediate taxable event. You might suddenly be hit with a capital gains tax bill that you had absolutely no intention of triggering this year.
So an abandoned kiosk in the ETF mall isn't just harmless empty space. It is a literal financial trap that can cost you through hidden spreads and surprise tax bills. Which is exactly why we need to leave you with concrete, actionable checks you can run on your own portfolio today.
Absolutely.
The biggest takeaway is that the letters ETF are just a delivery mechanism. The label does not automatically mean a fund is safe, cheap, or properly diversified.
Okay, so what is the checklist for our listeners?
Yeah.
If I see a new fund that sounds interesting, what do I actually look for before I click buy?
First, check the size. Look up the assets under management. If the fund has been around for more than 3 years and the AUM is under $50 million, you are stepping into a zombie zone. Proceed with extreme caution.
Good rule of thumb. What's next?
Second, look at the average daily trading volume. You want a fund that trades heavily every single day so that the spread is tight. That means you can get in and out at fair, predictable prices.
And what about the fake diversification check? I imagine that just takes like 2 minutes of reading.
Exactly. Simply pull up the new ETF's profile and look at its top 10 holdings. Then look at the top 10 holdings of the funds you already own in your portfolio. If NVIDIA, Microsoft, and Apple are staring back at you on both lists, you are not diversifying. You are just stacking your risk and paying a higher management fee for a shiny new label.
Makes total sense.
Finally, if you see a 2x or 3x in the name of the fund, recognize that it is a daily trading instrument that suffers from volatility drag. It is not a buy and hold investment for a retirement account.
It's just so fascinating because this massive global $21 trillion market was originally celebrated as the ultimate equalizer for the middle class. The invention of the ETF was supposed to give everyday people the exact same low-cost tools and market access as the Wall Street billionaires.
And for a long time, it really did. But looking at the data today, this raises an important question for the future of investing. As the market becomes totally flooded with doomed, high-fee niche products, and the vast majority of the actual wealth consolidates into the hands of just three mega managers like Vanguard, State Street, and BlackRock, are we still democratizing finance? Or, through the sheer scale of consolidation, have we just handed total control right back to the Wall Street titans who hold the trillion-dollar keys?
Don't forget to subscribe and hit that like button.